Okay, so imagine that you want to launch a business where your customers actively try to bankrupt you every single weekend. Using real-time data, complex algorithms, and absolute financial devotion, yet you still manage to pull in a net operating margin that would make a Silicon Valley software company weep with envy. Your physical footprint is virtually zero, your inventory is entirely imaginary, and your customer acquisition cost, which routinely hits $850 per head in high-stakes markets like New York, is amortized into total irrelevance within less than 90 days of a user downloading your app. The average transaction yields a theoretical hold of somewhere between 7 and 12%, meaning every single time someone places a $50 wager on a Sunday afternoon, you are effectively taxation clipping $4 to $6 off the top before the ball is even snapped. Analysts at firms like Macquarie and Needham have tracked this exact gold rush, estimating the gross gaming revenue of the legal American sports betting market to swell from around $7.5 billion in 2022 to well over $24 billion by the end of the decade. Sounds like a financial model designed by a sociopathic casino mogul who also happens to hold a PhD in quantitative behavioral statistics. And for the modern sportsbook ecosystem, that is precisely what it is. To understand how this balance sheet works, you first have to understand the massive structural shift that turned a murky Wire Act legal gray zone into a fully institutionalized asset class. For nearly 30 years, the Professional and Amateur Sports Protection Act of 1992, commonly known as PASPA, effectively quarantined legal sports gambling to the state of Nevada. If you wanted to wager on a college football game or the Super Bowl, you either boarded a flight to Las Vegas or you relied on a local, illicit bookmaker operating on paper ledgers with uncomfortably vague payment terms. The economic physics of that legacy model were raw, high friction, and localized. But in May 2018, when the United States Supreme Court struck down PASPA in the landmark decision Murphy v. National Collegiate Athletic Association, the federal barrier evaporated overnight. What replaced it was not just a collection of digital betting windows, but a state-by-state land grab where software operators, legacy casino giants, and multinational media conglomerates raced to stake claims in a newly legalized, highly regulated gold mine. State legislatures, hungry for tax revenue to plug post-pandemic budget deficits, carved out licensing regimes that traded high upfront fees, sometimes $25 million or more just for the right to operate, for a guaranteed cut of the gross gaming revenue. This regulatory mosaic created a high barrier to entry oligopoly where scale became the only path to survival. The core financial engine of a modern sportsbook does not actually rely on predicting the future. This is the fundamental misconception that keeps millions of casual bettors depositing money every single month. The sportsbook is not a gambler. It is an asset exchange that charges a fee for market liquidity. The mechanics rely on the VIG or vigorish, the built-in surcharge on every transaction, traditionally priced at -110 on a standard point spread. That means to win $100, a bettor must risk $110. If the operator balances the action perfectly, with half the money on team and half on team B, the sportsbook takes no directional risk whatsoever. It simply collects $220 in total wagers, pays out $210 to the winning side, and pockets the remaining $10 as pure, unadulterated gross profit. This 5% synthetic margin is the baseline mechanism, but the modern digital sportsbook goes far beyond simple point spread balancing. Through sophisticated algorithmic risk management engines, operators constantly monitor order flow in real time, adjusting lines not necessarily to reflect the true probabilistic outcome of an event, but to optimize total yield and manage corporate risk exposure. When sharp money, professional gamblers who consistently find positive expected value, enters the market, the sportsbook's automated systems identify the account signatures within milliseconds. Instead of accepting massive directional exposure, the book moves the line instantly, using the sharp money as a free, hyper-accurate data input to price out the rest of the retail market. Meanwhile, the vast majority of retail handle is systematically steered toward high-margin, complex financial products. The most lucrative of these is the same-game parlay, a financial derivative where multiple correlated outcomes are packaged into a single high-odds bet. While a single game point spread carries a structural house edge of around 4.7%, a 5-leg parlay inflates the effective house edge to upwards of 25 or 30%. By relentlessly marketing these low-probability, high-payoff lottery tickets through sleek mobile interfaces, sportsbooks have fundamentally shifted their blended hold rates upward, turning what used to be a low-margin volume business into an aggressive yield extraction machine. The sheer scale of this economic machinery becomes astonishing when you benchmark it against traditional financial institutions and media ecosystems. Consider the metric of handle, the total volume of money wagered through these platforms. In a single month, a densely populated state like New York regularly records over $2 billion in total sports betting handle. To put that in perspective, $2 billion in monthly consumer volume rivals the payment processing figures of major fintech verticals, yet it is generated entirely by consumers attempting to beat a mathematically rigged market price. When you examine the revenue splits, the true winner of this ecosystem comes into sharp focus. Take a standard $100 loss from a retail bettor in a high-tax jurisdiction. Roughly 15 to 50% of the gross gaming revenue is immediately carved out for state taxes. In New York, the state takes a staggering 51% tax cut off the top, generating over $1.5 billion in public tax revenue from sports betting in less than 3 years, a sum larger than the annual operating budgets of numerous mid-sized American municipalities. Industry analysts, such as those tracking commercial gaming data for the American Gaming Association, note that national gross gaming revenue from sports betting topped $11 billion in 2023 alone, driven by over $120 billion in total handle. Media networks have similarly tapped into this firehose of cash. Companies like Disney's ESPN, regional sports networks, and major broadcast giants signed massive multi-year distribution, marketing, and equity deals with major operators, effectively converting traditional sports journalism infrastructure into an onboarding pipeline for sportsbook user acquisition. ESPN's historical multi-billion-dollar deal with Penn Entertainment to launch ESPN Bet demonstrated that legacy sports media companies no longer view sportsbooks merely as advertisers, but as core infrastructure for monetizing viewer engagement. The financial footprint of the sportsbook has become so massive that it effectively subsidizes the broadcasting rights fees that keep multi-billion-dollar sports leagues solvent. Yet this hyper-leveraged growth model inevitably hits structural breaking points where the underlying math catches up with the hyper-expansion phase. In the early days of post-PASPA legalization, operators engaged in an unprecedented promotional burn rate, offering risk-free bets and deposit matches that burned through hundreds of millions of dollars in venture capital and public equity cash reserves. Companies were effectively buying revenue at a loss, spending upwards of $1.50 in marketing and promotional credits for every single dollar of actual gross gaming revenue generated. This dynamic triggered a severe market correction between 2022 and 2023, as Wall Street abruptly stopped prioritizing top-line user acquisition and demanded a clear path to positive EBITDA. The structural squeeze forced smaller, undercapitalized operators into sudden liquidation or fire sale acquisitions, leaving the market dominated by a tight duopoly of DraftKings and FanDuel, who collectively control over 70% of the national market share. As these titans optimized for net profitability, the user experience shifted dramatically. Accounts belonging to consistent winners or sophisticated quantitative bettors were restricted to micro-sized maximum wagers, sometimes capped at pennies, while high-volume retail losers were aggressively targeted with VIP retention calls, free tickets, and targeted push notifications. The breaking point of the pure risk-balancing narrative was fully exposed. Modern digital sportsbooks do not want a fair market where buyers and sellers discover a price. They want a closed, heavily curated ecosystem where asymmetric information guarantees that the house extracts a fixed rent from every single interaction, systematically excluding anyone capable of beating the spread. What remains is a completely restructured sports entertainment landscape, where high finance quantitative modeling, state revenue dependence, and media distribution have permanently fused together. The legacy of the sports betting boom isn't just the app sitting on millions of smartphones. It is the fundamental re-engineering of how live sports are produced, valued, and consumed globally. The broadcasts no longer just cover the game. They cover the line, the total, and the live-and-play prop odds, transforming passively consumed entertainment into a real-time financial trading floor. The house didn't just win by collecting the traditional 5% vig on a Sunday afternoon. It won by turning the entire structural economy of modern sports into a high-frequency margin engine where every single play is monetized down to the second, and where the balance sheet always balances in favor of the ledger. The game concluded. The hold percentage didn't.